Okay, everybody. Hopefully, you guys are good. So, this is Simplified Moving Average Strategy Part 1. And there's multiple parts to it. But we're going to start with a simplified view. You guys may notice, right? We go through a process, and, in my opinion, the elements that you've learned, these are the ones that are going to be key over time. Now, for some of you guys, you're just striving with it already. Some of you might just be completely lost, in all honesty. And if that's the case, you may not even want to go through this video. Maybe you should take some more time ultimately with some of the others. But if you don't feel completely lost, if you feel like, okay, I see it, it makes sense, I can't exactly do it, or certainly there's times that I'm getting myself into trouble, then what I would explain to you is like, look, that's going to take time. Ultimately, some are getting it great, some are getting it wonderfully during the trend, and some are just having a hard time identifying where I should be on time frame and things of that nature, which is the most common thing that I see. So it's not something you should necessarily worry about or stress about. It's very normal. So what I would suggest in this situation is that a video like this, and really the majority of the videos that you're going to end up seeing from now on, are going to be specific to strategy, right? Because it's my opinion that, look, I could have given this type of video very early on in the process and then tried to advance onto other things, but it's my belief that you'll see this type of video as a easier video based on the fact that you've had some knowledge with some other elements, plus ultimately to perfect what I'm going to show you, the material that you already have is going to be more useful. So hopefully I didn't just say a lot of things that just confuse you more, but the idea is that we're going to get into parts and elements where we're talking specifically now about strategy, we're talking about sharpeners and things of that nature to allow you to really put together your plan. Because to take a psychological element from it, market psychology and trading psychology, the reality is you need to start becoming your own trader, right? You're not going to be Mr. Anderson, right? And that doesn't mean you can't be better than me. You can. My point is that I have my mind and I have my drawbacks and I have my battles that I'm going to fight within myself. That's normal. So you also need to think for yourself and see what's going to make sense for you based on time frames and your schedule and your life. I got 4 children. You may have none, right? So maybe it's more conducive for you to be active and trading on lower time frames and things of that nature. So that's all part of this process of saying, look, I can learn technique from this guy, right? But it doesn't mean that I have to be him. And that's the best possible thing, because the reality is if you could begin to start that process of seeing things for yourself and understanding that, look, I just need to process this and understand it, and that takes time, and it will come and come and come, because it has been coming. And even though I've hit some spots where I'm confused, that's generally a good thing, right? Because it lets you know, like, okay, wait, in these circumstances I struggle, right? So I have to continue to progress in that way. And in this particular segment, what we're going to do, we're not going to go too deep, right? I'm going to keep it fairly general on this moving average strategy, and it's not really anything that you haven't seen, right? So to sum it up, just to give you some quick basics, I can even just type them in here. Let's just start something new. Well, here's the first thing I want to do. Let's just get rid of this guy. Okay, let's set something up. I want to show you how we're going to do that. You could pause it if I lose you on any of this, but just in case you go over, set up a whole new screen for something like this. One of the best ways to do that, in my opinion, is you go and you make a copy first, right? You get to name your copy. In this case, we're going to name it Simplified Moving Average Strategy. You can call it A, B, C, D, G, whatever you want to call it. I'm going to call it Simplified Moving Average Strategy, just like that. Except I'm going to spell it right. Let's call it like that. And then I'm going to clone it. And what's going to happen is basically all it does is it's going to give me exactly what I had on that screen, except now it's going to have a different name and a different layout. So obviously I don't want everything that I had on that previous screen. So I now have to correct some things. So the first thing I'm going to do in this situation is I'm going to go to one screen. We might change this later, but let's just start by bringing it down to the one screen here instead of 4, which I previously had. So if you had multiple screens, do that. I'm also going to clear everything out. I don't want any drawings on this one. Let's clear that out for now. And then I'll go ahead and resave it because I've now made some changes. There we go. Now anytime I bring it up, it's going to look like this. I'm going to make some additional changes as well. First of all, I don't really want to have my 200s up right now. You know me very well. I normally have them up, right? I'm not going to have them up at all at this point in time. And you're going to, I'm going to go ahead and give you away all the secret ingredients right now, right? And there is no secret ingredient, of course, right? Because what is a moving average? A moving average ultimately is just looking at a trend. One is a trend over 8 periods. One's a trend over 21. One's a trend over 13. One's a trend over 55, 189, 200, right? And it's giving us perspective of trend during that timeline. And that's it. Don't overthink it. Then we can utilize that to compare to each other, etc. But we don't want to get so lost in thinking that one's magical, that one is special, or anything along those lines. And in this one, we're going to use the 8, the 13, the 21, and the 55. And that's it for now. Later on, we're going to add those 200s back. But for now, I just want you to look at this as I introduce this strategy. 8, 13, 21, 55. Now, we're going back in the day now. This is old school Mr. Anderson. He's just learned moving averages. He graduated for something from like a 10-20, which still is another great strategy in its own right, and eventually we'll just go over that the right way also for those that like to utilize that. But in this one, this is one that I really cut my teeth on once I felt like I was becoming a successful trader, and it's very simple. And the beauty of it is this: it works on just about every time frame, right? And what you're going to notice is, what does that mean? Does that mean that it has a 90% hit rate on the 5-minute chart? Of course not, right? We have to understand a little bit of market psychology always when we're trading. Like if I'm trading on a 5-minute chart, things better be very volatile and trending, right? Otherwise, I'm going to get chopped up, and that's something that we've spoken about many times before, and you should be learning and should understand. But I'm still going to give you some examples of this so that you have an understanding. So I don't think I have to write this out because I just showed you, but just in case, let's go ahead and you can pause it if you need to. If you want to write it out, I'm taking the 8, the 13, and the 21 EMA, and on my screen that's green, purple, and blue, and the white 55. That's it. Now, if you've seen the 2155 strategy or the 821 or anything along those lines, then you're going to be fairly familiar with everything I'm going over here. But the approach now that I'm doing is I'm utilizing a different approach to where the reason why this is going to help you out is that, one, we're not going to change time frames, at least not today, right? I mean, don't get me wrong, we're going to skip around from the 1 week to the 1 day and things of that nature. But when I say we're not going to skip time frames, meaning we're not going to take a signal on the daily and bring it down to the 4-hour. Is that a great strategy? It's an unbelievable strategy. It's genius to do that because you're going to sharpen up yourself in a lot of ways. But for this one, we don't have to. You could stay on this time frame, okay? And the process is very simple. What we're looking for is we want to take our 55 white, right? And we want to see it get crossed by the 8, the 13, and the 21. All three of them. We want all three to cross, whether to the upside or the downside, which means you're always going to be under either a long signal or a short signal. So let's take a moment and understand that. Am I saying that, hey, you should always be long or you should always be short? Of course not. I'm not saying that at all. But the basis of this particular trade is everything that I just told you. Okay? Now, there's some caveats there, but we're going to start with that. What is that going to look like? I'm going to show you, and I'm not going to show you one example. We're probably going to show you about 20 examples here, right? Because I want you to have an understanding of it. Now, first thing is, let's look at it at something like scale. Anytime we say something like scale, we just mean like going to a higher time frame, right? So when I say look at it at scale, let's go ahead and see what it looks like. Of course, at scale, it should do very, very well, right? And the entry is going to be this. Now, technically, the idea is when you get an 8, 21, 13 cross, this one happens to be to the long side, right? Because they're crossing to the upside. That is going to give me a buy signal, okay? So take some notes if you want to along the way. So you hear the key ingredients. I'll point them out. I've already pointed that element out as the key. But it's 8, 13, and 21. Okay. And now when they cross, which is this point right here, that is technically our buy. But what I would tell you is that what it's really giving us is it's putting us on alert that we're going to look to buy. Because ultimately what normally happens in these situations, now remember, right now we're not going to talk about the 200. I probably won't bring it up. I might just show you a little bit later. But I'll put that on the next video where we can talk about, all right, now one element, yes, that might confuse you a little bit more when we add the 200s in there. But at the same time, it can certainly sharpen some of the flaws that you might see with this. But the real purpose of this is to kind of get you out of a habit, if you have it, of having the wrong time frame or having too tight of a stop perhaps, or not giving yourself enough room. And this is really going to help with that, because we're going to talk about stops. We're going to get pretty specific here, okay? And here we go. So we get a cross right there. Now, does that mean that I buy here? Well, listen, for the sake of this conversation, you can. You know I say don't buy the cross, right? But for the sake of this conversation, if you want to go ahead and look back at all the examples and just take when all of them cross, feel free to do that. Of course, on lower time frames, you'll see a lot of chop happening. But what I'll say is that, look, the reality is the cross didn't happen here. I want to make this big, because what we're looking at is this. Normally, what we're going to find out is that you're getting something like a trigger, so to speak, right? It's not the push the buy button trigger, but it's giving you that directional bias that we always talk about, right? So the directional bias becomes long, right? The moment that all of these cross, which happens basically on this day on this big candle. Now, you're savvy enough to understand what? That this candle has stretched out. Look, sometime this run, especially at scale, yes, it can. You may not get an entry, and we'll probably get further into that on the next video. But normally, what's going to happen on all time frames, once this cross happens, is that you're then going to see some element of a consolidation. Consolidations come into many forms, right? In this case, we're seeing what? A bit of a triangle. And then what's happening is you see a bit of a moving average squeeze. Now, it doesn't always include all four, right? But certainly will include the three. So I'm going to clear this off again because I don't want to obstruct your view. But you're going to see typically price is going to pull back in. And then what we want, as opposed to any of the other strategies where it's just 821 or 2155 or anything along those lines, or 55200, in this case, we just want to see price interact with either one of them or all of them. We want it to find support and then begin to move back in the direction of our trade. That's the idea. That's what we would like to see in this setup. So take a close look at this for a second. Now the question you might ask is, all right, well, how do I know when to buy? Well, it's a great question. Of course, that's what matters most. So this is where we get into things like establishing a local low. One of the best ways to do that, of course, is to find yourself an area where you start to see some support. So yeah, this is fair to say, hey, look, this started to get support here. But in reality, I would need to close a candle above this level for a buy if I was utilizing this candle. Well, then the next one comes and that level changes, right? So now I would want to close a candle above this previous high to take a long. So if this candle actually would have closed right there, I'm into the long side. I'm taking my time here. We're going to run through a lot of them, but I just want to take my time in the beginning. If you notice that I'm about to move on from this section and you're not understanding, rewind it a few minutes and get the whole thing over again, because this is the crux of it all, okay? This is the important element. So you don't see it here. Okay, next candle. By the way, if this candle was small and down, I don't care. I've already interacted here. If I see a candle takes out the high of this candle, I would be long. Well, that gets actually moved down to here. Well, now it's very low, right? Ultimately, if it takes out the high, I'm going to be long again. You see the high in this case, you're going to include, by the way, I didn't do that here. Forgive me. I showed you this. I meant the wick high. Forgive me. So if it took out the high there, and then on this next one, it would be the high here. So you want to take out the wick as well, right? So the high of the wick on close, that's an ideal situation for establishing a local low, right? So in that situation, and this would be on the buy side, of course, if it was a short, it would be completely opposite, and we'll do those examples as well. But in this situation right here, it would be this candle, which would be my buy. Now, it could have been any candle, right? But it just happened to be this one. Why? Because it took out this level right there. I know that's not a straight arrow, but it took that level on close. That's it. I'm counting this as my local low. But here comes the key. Normally, what we do is we say what? We say, oh, well, let's go ahead and if this is my local low, let me set my stop right here. Now look, what we'll talk about in the next video is if you still want to do that, you absolutely can, even with this strategy. But I want to get you guys, some of you guys, off of that for now. I want to get you off of that for now. I want you to start having the mentality of, look, if I have a directional bias, right, meaning I believe it's going this way based on a strategy of some sort or my TA, okay, let me give it room, okay? Now, what the strategy calls for is this. I technically am not going to cover this trade. You ready for this? until I get a recross of this 55 with these moving averages. Understand what I just said there? I would need all of these moving averages to now bear cross this 55 for me to exit this trade, which means on the weekly scale, I'm going to be in this trade for a long time if things are going very well. And that's sort of the point. Now, what we'll talk about later is like, look, if you want to put it at a swing low and a little bit lower based on the fact that you don't want to just get hit with a giant candle, you can do that, but let's not even entertain that right now. Let's talk about big losses. And this is important because I do want you to actually present yourself this scenario because, look, think about this for a second. If price actually begins the process of falling, let me just see if I can find my little drawing tool that I absolutely never use, which is this one. So in real time, remember, we're entering on this candle. So let's just imagine a scenario where none of this exists and price starts doing this. Well, guess what? If price does this, it's still going to take a significant amount of time for these to cross over. So I have to be prepared to set a stop because, of course, you have to set an initial stop, right? There's always a lot, I shouldn't say always, but oftentimes there's two stops, right? There's the I can't possibly let it fall this far type of stop, right? And then there's the stop of what your strategy says. So the strategy says I need a complete crossover. But if intraday this thing drops way down here, well, then you have to set a level to where it makes sense. This is a weekly scale trade. So this is where you start to think for yourself a little bit and understand, because in reality, the real stop is down here. It would be a swing low in this situation. Now, it's not going to get that low, but for positioning size, you would have to create it in that scenario. So let's say you said, hey, weekly scale trade, I'm willing to lose 3% on this as an example, only because you see it's such a distant stop and it's probably more unlikely to happen. You'll probably stop yourself out prior to that. But you have to set it that way to give yourself the room to make an understanding that, hey, this is way out, and therefore I have that protective intra-week, intra-day type of scenario, because ultimately what you'll see in a minute is that to recross is going to take a lot, right? Now, can you change this down the road? Can you make a decision that, hey, you know what, I'm not going to let it go all the way down here, or I'm not going to let it recross the 55? Yes, you can, but don't worry about that right now. It's going to be a lot easier to go through these examples if you just free your mind and just let it run, right? So the selling point is way down here. Okay, so what does that mean? It also means that, hey, we're not immediately setting up a situation where we're saying, hey, we know we have a 2-for-1 or a 3-to-1 risk to reward to risk type of scenario. We're not going to know what that is, so it's still key just to set the proper risk management element based on, hey, I'm willing to risk 1%, 2%, 3% based on this distant stop. You might say to me, hey, what about this one right here? I'm okay with that. I'm giving you this distant one because more often than not, you're going to find that swing low. Excuse me. But in this situation, if it happened to be this one, that's completely fine. But give yourself some room. If you guys are familiar with the ATR, which we've talked about before in a couple videos or in a video, and we spoke about it certainly on Discord a few times, it's a very simple process. You could go in and type on ATR in the indicator, and it'll basically just tell you the true range of your particular chart that you're looking at, and set it at 1 or 2 ATR, find out exactly the dollar amount, and go below that. By the way, this is something you can Google very easily, but if you're truly lost on that, I would suggest asking people in Discord, or if you need me to go over it, I can. I don't want it to make it something that's super complicated. I mean, ultimately what we're saying is pick a spot below in case there was a stop hunt. So if you said, no, I want to just take something that's under that 55, okay, give yourself some room, right? You don't have to go all the way down to this level, but give it some room. Let's say this candle below, or this candle top as an example. Something that just gives you room, because that's what all this is about, giving yourself room. So now we went through a lot of that. Let's now look at some results of something like this at scale. We know this. I'm going to go ahead and put a vertical line up here if I could find it. Which is right there. And we said that, look, our entry, excuse me, that's the wrong one, was right here, which was the higher candle after we had some interaction, because we don't know, right? The idea of this strategy is, look, I don't know if it's going to interact with the, oh, I'm on the wrong one. Forgive me, it's this one. I don't know if I'm on and forgive me again, 100%, that whole example that I give you, I was actually looking over here. If you guys noticed that, then yes, you're absolutely right. That would be the target level right there. And again, so give it some room, as I mentioned, below the 55, below the swing low, because things wick, right? We see that all the time where you get a wick or a wick. So in this, we want to talk about giving it room. We're going to do this on the 1 hour. We're going to do this on the weekly. We're going to do it on every time frame you can imagine. And on the weekly, same thing. Give it some room to develop because you have seen this. And this is telling me that this is most likely an uptrend. That's what it's telling us. That's the idea of getting an 8, 13, 21 all crossing the 55. All right, so here we are. And that's my signal. Well, this is the fun part. We kind of get to see what happened. All right, well, we're not going to sell until what? Not till price crosses the 55, until all my moving averages cross the 55. So this is a weekly scale, and we know that Bitcoin loves to trend when it gets going, right? And therefore, what are we looking at here? We're looking at an entry here. By the way, anything that we're going to look at today, I have not looked at, including this. You know, I always like to just kind of run through these fresh, so there's not like some added cuteness where I'm saying, hey, look at how great this is, right? I'm actually going to show you the bad parts of it as well, which I always do. But at some point, this thing went up 5,000% on a weekly scale trade, which is absurd. Now, based on this strategy, technically, we wouldn't be exiting until all of them cross over to the 55 side, which didn't happen till way back here. Now, this is where part 2 of this comes in. Are you going to let this thing drop from 20,000 down to 7,000, 6,000? Of course not, right? But the idea is that even if we keep something in mind to where once we get running, we say, all right, well, we'll exit on a close below, the 21 or something along those lines. That never happens either in this example, right? Doesn't mean it won't happen, but in this example, that never occurred, and you're still holding on to a significant amount of gains. On the weekly scale and at huge scales in general, of course, you're going to have to make some adjustments to the strategies that we're talking about, but when we get to the lower time frames, you're going to understand why I said it that way, and ultimately it'll start to make sense for you. But I want to look at the other side real quick and just set a couple areas. So now let's wait till the downside. Well, the downside was here, right? And I'll just go ahead and mark the area off right there. This is the moment that the green, the purple, and the blue had all crossed below this white finally, right? And then we're going to wait for what? Some interaction, right? And then for a close that gets below a previous candle, right? So in this case, our patience, we would have had to wait ultimately. I'm not, you guys can get cute with this, obviously. If you see this candle and that one, and then you see it close below that doji, you can take that trade. But for the sake of argument, I'd rather say that you took this one, right? So let's just say it was way out here. Of course, you're probably not going to be trading on such a high scale on Bitcoin, but the idea is this, meaning that a trigger chart of a weekly is pretty high. But the idea is that you still see 40-something type of percent. Okay, well, let's go. Let's go the other way. It'd be nice to find a loser, right, on this, but what you're going to find out is on something like Bitcoin, you're probably not, I haven't even went through this, you're not going to find the loser. On this one, you end up getting reaction pretty quick. You get a reaction, takes out the high right there. That means your entry is right there. We set a very distant stop. And eventually you start to see a run up that gets you as high as still 50-something%, despite the fact that you missed all of that move, because naturally this is a slow strategy. So I'm going to erase all that. Excuse me, I literally want to erase it like this. And we're going to take this down to a 3-day. And then we're going to look at other charts also, not just Bitcoin. But I want you to see the same strategy. And I'll go back to the beginning of time. Doesn't matter if Bitcoin's going up. It doesn't matter if Bitcoin's going down. It doesn't matter if it's going left. It doesn't matter if it's going right. Okay? It's the same type of strategy that we want to look at. This one might be good because let's see if it struggles here. I get my bear cross. So here's a great example because I end up getting a bull cross here, right? Well, remember, after the bull cross, I want price to interact and then rebound and take out the high of a candle on close, which doesn't happen. So this actually never becomes a signal. See this? All cross to the upside right there, and it just simply never becomes a signal. If we go a little bit further back in time, looks like I would have missed a signal right there, right there. Again, I'm not going to try to cherry pick anything. I'm just giving you fair assessments. We were looking for an interaction, right? Because we know what? We know there's going to be some sort of consolidation, right? That's very normal. Action, consolidation, expansion coming. What happens? We start interacting. This candle takes us out. As you get more savvy, yes, you can. I know you guys a lot of you probably think, well, can I lower the time frame? Can I front run? Can I do those things once I get my interaction? Of course you can. Remember, technically, if you wanted to even enter on that, you can. It's just that that is a front run on itself because we're not seeing if we're getting the reaction we want. Because what we really want to see, right, is that we get a directional bias, right, and then we want to utilize either our TA or just the rest of the strategy to get a confirmation, right, of the reaction off of that. Are they buying the signal? Are they selling the signal, right? Because this, I assure you, is a professional, as simple as it is. This is what professionals do, right? This is what bots do. This is what a lot of the algos for big firms are doing, something that is very simplified. And they're looking for trend. I mean, that's the whole thing. If they can participate in trend, they will. When things are choppy, they'll utilize some chop algorithms just to chop you up more and more and more, and that's the idea. But here we are. Remember, we're not even looking at the 200s for any of this here. We get that consolidation. We get that interaction. So from right there, if that's a spot, so be it. That would be your entry, right? And we would literally give this what? All kinds of room. We would basically be saying, like, look, here's our 55. Certainly, we're going to wait until all the moving averages cross it. That means I got to set the swing high way up there. See that swing high? And this is actually a great example because it's very high and your position is going to start off that way. But then, obviously, things start going well, right? You entered here, things are going well. You get, look, all these big snapbacks, they don't hurt you. If you were, normally you might say, oh, if it crosses the 8, I'm out. If it crosses the 21, I'm out. But you see what's happening here? This is giving you the room. In fact, it may cross the 55. And you would be patient in that situation because you have a distant stop. But then once it falls off again, guess what I do with my stop? Move it to slightly above the next swing high, right? This is a lower high. So again, now I've moved my stop. So yes, I'm still waiting for a total cross, but if price gets up here, I understand that, hey, let me just get out, right? Without less harm. Same type of scenario happens again. It dumps down. It comes back again. Look at this. Another swing. And I'm going to give it some room. We talked about something like the ATR, etc. And then ultimately you see that it holds off for a while, but then what happens right there? You see that element? Guess what? Everyone crossed. And this is actually the perfect example. Again, I did not expect to see this example, but it ended up working out very perfect, which is that what? You end up in a position like, it's very long. It doesn't mean you can't have other positions. It doesn't mean you can't be trading on different time frames, but you might have a trade on the 3-day that you're trading. And in this case, price is over here in this region. It's a 34% type of gainer. At one point, it was 65%. So yeah, did you really let it go back all the way that way? Probably not. You probably took some profits in here, maybe add it back a few times. There's a lot of ways to play it once you get good at it. But for now, for the sake of argument of this conversation, just do it this way. Okay. Now, what happens here? Cross again. So now we're looking for a long. But guess what? We don't get that reaction. Oh, okay. Understood. Now we're looking for what? A short. This is perfect scenario because this is exactly what I wanted to. I want you to see some confusing elements, right? So now we're looking for a short right here because they all cross again. Let me go ahead and just mark it off. Right there. Whether it's here or there, it doesn't really matter. One of these levels, but what do? Do we buy it immediately? No, because remember, this is giving us a directional bias. We want to see an interaction. I like this one because it's going to be a failure. This is even better. So we do get that interaction, and then we do get that close below that candle. So this is our buy point right here. Now what you'll notice is that, yeah, this one begins and starts to look okay, and then ultimately it's going to fail. But what happened? If we set the buy here on this high time frame, we're setting our stop way up there, right? So it starts way up there, etc. Right? We're setting a stop up here, above our highest close, which is there. Give it some room ultimately, and then you're going to put yourself in a position to where, guess what? Price ends up crossing back over. Remember, for the sake of this strategy, that's not a sell by itself. This would not be the selling point by itself. Now, there might be other reasons why you decide to exit, but for this conversation, I want to look at this as a loss. And really, your selling point would be right on that candle right there, actually. And it kind of corresponds with this. So you might say, well, whoa, that's a huge loss. And you'd be right. It would be 30-some%. But it doesn't matter what the loss is, because if you had to set your stop that far out, keep in mind that your position would have been smaller to begin with. So your maximum drawdown in that situation was still the 1%, 2%, 3% that you had chosen, right? And again, don't forget, of course, we can be wiser about how we go about doing this. I'm just doing this for the example of this conversation. You'll hear me point that out 100 different times, but I like this one. I like that this worked out this way because it shows you exactly the scenario that we're looking for, which is that, look, you're going to basically take a shot on directional bias, and you're exiting on a cross, right? So I guess you could say technically a cross right on that guy, but either way, it doesn't matter. Point is, no matter what, that would be basically a loss. You'd be taking your max loss, which would be 1, 2, 3%, etc., based on your risk management element. And then we're back to this guy right here. That's the cross. And here, same thing. We wait for reaction, right? And then wait for the high to get taken out on close, which happens right there. That's my entry. I'll run through a bunch of these as I mentioned. And then what do we see? It just doesn't come close to recrossing. And one of the reasons why I'm willing to take my 1, 2, 3% loss over here is you'll see that when it does work out, guys, it's designed. The reason why you'd be open to something along the lines of a very far stop initially. First of all, you can add to your position on these swings, right? Meaning swing high, swing low type scenario when you're making a higher high, lower high. But also, you're creating a scenario to where eventually you're catching trend. And not only you're catching trend, you're catching almost the whole trend, right? And now we're back into this 5,000% scenario because on this 3-day trade, we never even thought about a recross, nor did we even see price challenge the 21. Now, I'll go ahead and cheat a little bit, which says, look, if you decided that you were going to, I say 21, let's say you said you were going to give it on a 55 break, which never happened. But if you snuck that into like a 21, probably say something like a 34 would probably make more sense. But let's say you did get stopped out a couple times. Well, same scenario would occur is that if it then took out the high again with a candle, it's like another buy signal for you. You're just re-entering. So if you gave yourself some extra protection here, so be it. You could always re-enter that trade and still participate in the trend because that is the purpose of this. We want to find short-term trends and sometimes long-term trends in this situation, right? So obviously you guys love Bitcoin, so we're just going to continue with that theme. Technically speaking, we know that the stop would be way out here. Of course, again, are you letting it go from 12,000 to 9,000? No. This is something that went super parabolic, so wherever you covered, it still would have been great. I'm not saying you would have got the whole damn run, but even if it was in this range, you're talking about 3,000%, which is insane. Again, that's an extreme based on what happened in that market, but let's just look at something like this. Now, the market had already pulled back $11,000 as of this moment right here, and we get what? A sell signal or short signal. Great. So now we're looking for what? An interaction, right? And then for it to take out the lows. So guess what happens? It even makes it back above the 55. Does that mean that it doesn't work? No, it turns back to a long when all the moving averages cross. So when we get this candle, now it's below the lows over here. We have our sell signal. We're now back below the moving averages. Thank you very much. This is my entry yet again. And guess what happens over here? This is great that this happens because we see price now go again above the 55, but the moving averages absolutely do not. And we're holding on because we want to see trend. Now this one you're in for a long time, but eventually you get the mega payoff with the big guy dump over here. And you see at some point on the short side a 62% gain, which is amazing, right? That's an incredible gain. If you know much about shorts, the way it works, you're talking about significant benefits there. Ultimately, when you're gaining 62% on the short side, it's pretty amazing. Okay, so that's that, etc. Obviously, there's some covers in here. Where you decide to cover, we'll talk more about that on the second one. But the technical cover wouldn't have been till what? Till the crossover over here. And of course, we've already explained that. Well, you might have let that one go because that's still 42%. So I have no problem. Like maybe you were ultra bearish and you said, no, I'm going to wait till I get my crossover or set a stop somewhere else. That's fine. If you decided I'm willing to risk 50% of my gains or 25% of my gains, that would make sense too. Or a secondary high, give me a higher high, and once we got to this bottoming formation, etc. We'll get to that in part two. Here we're just talking about the strategy again, and the key is don't look at this and say, oh, look at the drawdown, meaning how much I give up. That means it's a bad strategy. No, look at the effects of the strategy itself, right? Because we're trying to simplify things. Now, of course, at scale, this thing's going to look beautiful, right? But of course, when we get to the lower time frames, you'll see a lot more chop, which is, of course, what it should be, right? But same scenario. We get that signal right there. I'm going to move it because it's in the way, but it's right there when we get the signal. So now we just want to see interaction. We end up getting it pretty quickly here, right? So next candle. Now I can understand if you didn't take any of these, that's up to you. You might even have waited to here on this particular scale, but we did get an interaction and a higher high, and you see the thing took off. And then the same thing happened here as well, and you've seen some consolidation, and then it went again. So any one of these is fine. It doesn't change the equation, which is that what? That you basically would have been in a trade that gained a lot and certainly gave you some take profits along the way to make sure that you participate in something good. Let me go down to a 1 day, and then we'll look at some other assets, okay? Because I just want you to see basically how these things do. Bitcoin's one that trends, right? So if we're utilizing a trending type of strategy, that's a good thing. But I want you to see that when this thing does trend, this type of strategy is going to do you quite well, right? So here we go. Right there's your break point. Okay, you're waiting for what? Consolidation, interaction, etc. Maybe you see that as right here. I understand that, right? Because technically that did happen. We got interaction, and then we made the lower low right there, and then it started snapping back, right? Okay, well, at that time, the initial time, your stop is way up here. So you might say, oh, my position has to be pretty small to have a stop up there. Okay, what's wrong with that? You can have a small position. Remember, as time moves on, you'll move this, and you could also add to your position in this situation over here if you'd like to, because you're going with trend. So the key is that there's never that cross. You see how close the 21 gets, but guess what? It doesn't make the cross. There is no change. And then look what happens, this dump. By accident? No, not by accident. It was not an accident at all that occurred. That's the idea. So here you are. You started. It's looking bad. I'm down. I'm down. I'm down. Nope. And you probably add it back to your position as well. And look, this thing would have been a sideways mess for a long time, but you probably would have felt pretty good about where you're at in position wise, because you're noticing that the trend's on your side, and then eventually the payoff, right? Again, even on that daily scale, the big payoff comes, and the recross wasn't until over here. We talked about that. This would be a very long-term type of trade, which is okay. There's nothing wrong with that, especially if that pays you, even waiting patiently all this time. 40% on a short. Remember, on a short, that's insane. We're not talking about 40% on a long, which is awesome, of course, but longs have the potential to go to 200, 300, 400%. A short can only go from 0 to 99, right? And of course, nothing's going extreme to 99 except the poop coin over a 2-year period, right? So that's kind of the idea. You end up going long in. Now, I'm not going to map them all out. You can see it. Look, long here. The whole thing runs. Literally, you stay long all the way about basically up to about 10,000. Of course, you could have made some decisions other than that to get out sooner. But again, that's part two. Let's not get too deep into that. We're not even using the 200, right? We're not even using stochastic at the moment. We're not even thinking about RSI, okay? We're just looking at the moving average strategy. Now, what about the lower time frames? Can I do it on a 12-hour? You're damn right you can. You're damn right you can, right? So let's look at it some more. Here's the cross. Well, where is the cross? The cross is right about here in this range, right? You see it? So what do we expect? Some consolidation? Guess what? We get some consolidation, just like that. Now, it didn't react immediately, so we wait for it to break down again, right? And eventually, wherever you got in, doesn't matter if it was here, was it here. You can fine-tune that as you go along, etc. But guess what? Never get a recross. You get the big payoff on a dump here. Stays short the whole time. Now, would you have gotten caught on that thing? Yeah, most people would have in that situation, and that's fine though. Guess what? You would have gotten caught by it on this scale on the 12-hour, but you would have also done that after a significant drawdown. Again, you're probably taking 25% profits into some of these giant dumps anyway, trying to re-add. So your positioning will be a little bit better, but I don't want to sugarcoat it. Even if you got caught by that, guess what? It's okay. You'll notice that your entry was way up here, and overall was still a winning trade. And then, basically, at the current time, it's trying to enter into that process yet again, which would mean what? Consolidation first, and then see if you get a reaction. Because remember, you're getting the consolidation first, but as we know, compression, expansion doesn't always go in the way of trend. So we want to see that. Are they buying it? Are they selling it, etc.? So that's always going to be a key. And that's why waiting for some element of a test with the moving averages, any of the three, even any of the four, are fine, because then you want to see it get shot out the other side, basically, right? That's kind of the idea. Here's the cross right there as an example. Look, flagging type of consolidation. Price did sneak back above, right? So, okay, that happens. There's other moving averages, etc. We understand that. And then we make that low. You see it's a nice trade, right? Eventually what you'll understand is that it's going to give you nice trades, right? But if we look at it for what it is also, you're seeing big moves after, right? So once you get there and clear, you can see that it does clear it. And then, of course, I'm showing you choppy areas over there. Now let's look at what happens if we happen to get in prior to a trend, right? Which of course we never really know specifically, but you could see that you're keeping this even at something like a 12-hour. The type of amazing things that can happen. The 12-hour gives you that signal right there. Now, whether you entered here from this interaction or waited for this interaction is fine. If you waited for it to come back in, notice that, all right, I'm still in that buying position, and the moment you get this candle here, again, this would be your buy, even if it wasn't before. Your patience was probably lingering a bit. I'm only up 5%. I'm only up, you're in it 4 weeks essentially. But then guess what? You get your payoff, right? And then you also understand that, hey, Maybe you move your stop down to a close below the 55 or even a close below the 21. If you did that, you might have got out there. And again, we'll talk more about that in the second video, which means you would have re-entered over here. So you might have missed a small area. Who cares? You're in a trade to make money. But the idea is, according to this strategy by itself, technically your exit is what? Waiting for the full crossover, which doesn't happen, guys. It does not happen at any point, right? You end up stretching all the way to a maximum of what? 260% on a 12-hour before a significant legit drawdown starts to happen. And then the cross happens over here, of course. That would bring you down to, even if you were very strict and waiting, 175% still, which is incredible, right? This is the stuff that we dream of, right? 6-hour. Let's cut it in half again. Now we're getting low with this. Can you do it on a 2-hour, 1 hour? Yeah, you can do it. Can you do it on a 15-minute? You can. You can. You just got to be a little wise, guys, right? Now you got to start identifying trend a little bit in those situations, but you can do it, and I'm going to show it to you. Now, 6-hour will run through this because you guys can do this all on your own. The moment you're done with this lesson, start running through a bunch of examples because I'm not going to keep this one going too much longer, and then we'll just wait on part 2 for that. But ultimately, look at the 6-hour. And you're gonna find examples where it fails, and that's fine. That's that's your 1, 2, 3% loss, and that's okay. But this will help a lot of you guys. Why? In my opinion, because you're gonna be able to set a more distant stop, right? Because I think what's happening is you guys are coming down. The ones that are struggling, and it's normal. Why do I think that? Because I know that's what a lot of people do, right? It's very normal for time frame identification. It's very difficult. You probably will hear me talk about a lot. I'll say, in my opinion, the 12-hour is the one that's in worse shape right now, right? Which means, in my opinion, the trade's on the 12-hour, right? Or the daily is, or the 4-hour is, right? And it moves around, right? So it's not easy. But this allows you to say, look, man, I can pick whatever time frame I'm at, and then give myself a directional bias, and then give myself room, right? To not say, because I know a lot of you guys, you say, oh, I'm going to take this recross here. I got the 8, 13, 21, etc. I get this recross right here. I'm in, right? Well, this is a terrible example because it works out well. So let's just say, one of these. You said, I'm in right here, right? So you're in, and then it starts, and then it recrosses the 21 here, so you're out. And you're like, oh, I'm out. And you really just gave it from there to there. In that situation, what I'm saying is like, no, look at your market structure, right? And in this situation, this is the signal, right? So in a worst case scenario, meaning the lowest that I'm going to set that is to say, look, swing low, right? Something like that. When we say tight stop, then yeah, man, that's tight, right? I'm not giving it the lower low, right? It's a swing low, but I'm giving myself at least a chance and a directional bias. That's the idea. And what happens, you could see that you do catch good trades in there. Some of them you get stopped a little bit here and there. We haven't seen that quite yet, but it will happen, especially on different entities and assets. But ultimately, remember, this is not a sell because the 21 doesn't, the 8 crosses, maybe even the 13, but the 21 never recrosses on that 55. I'll show you closer so you can see. The fact that the price did doesn't mean you have to take that. You have a distant stop way out here. You might have moved that stop to the next swing low right there, for a close or a wick into that area. You might have said something like, okay, well, I'll move my stop up. I moved it from here to here, right? Then as price goes on, okay, maybe I'll do it again like this, etc. And every time you start to get these swings, you might do it again. So I mean, ultimately, you're over here in this area, and then you flattened out and you took off again, and you moved it up now to here as an example. And then finally you based here, and you went one more time, and you brought it to here as an example, right? So we're moving that stop even though it's distant. So we always have that two-stop system. We want either all the moving averages to cross, right, which happens right there, or to hit our spot on an intraday level or something along those lines. We moved it up yet again in this situation, and then finally they all cross here, and I'm out. But look at that trade, guys. I mean, you're here to here. You're here to here on a 6-hour. That's the idea. This is going to help you to give yourself some more time. So 4 hours is going to work the same. Let's look at some lower time frames, something like a 2-hour, which is a time frame that I do like to trade as an example. We're on Bitcoin. Can it work? Should it work? Let's go ahead and look at what we're dealing with here. Well, let's see if it can work. The cross happens right there, right? So there we are. There's the cross. It's right there. That's my signal. Boom. I'm waiting for a consolidation, which happens. I'm looking for some interaction that occurs. And then I'm looking for a candle to take out and establish like a local low that happens right there. And now I'm in this trade. And you might notice, hey, this thing snapped all the way back. Yes, it did. Now, again, I give you guys flexibility here. You're on a 2-hour chart. You might decide, like, hey, I'm not going to give you that much because it just gave me, a trend or expansion down. But maybe you want to let them go completely, and that's what the strategy says for anyway. So I get it. If you came back to zero, you may not like that, so you had some elements of stops. But again, based on this strategy, I'm waiting for a complete cross. So in reality, remember, my initial stop was my swing high, right? Right there. So I entered here, but I'm giving it all the way to the swing level, maybe even a little higher than that, right? Maybe an ATR or 2 ATRs above that level as an intraday to start myself off. And then when something like this happens and it dumps out again, I can move that as an example, right? When something like, when a reaction happens in here and I start to dump lower, maybe I add to it. Again, these are things where you start to think and become your own trader, etc. Because you have to have, that's a little bit more advanced, obviously, to do that. But you're in a situation here to what I'm basically explaining is, look, this is going to give you room. That's the idea, right? Give you room to be right or wrong. Because what I notice is that someone will say, like, hey, from here to here, I lost 7 trades. Well, I bet one of those trades, the worst thing is, let's say you're short during that time. It's like, I want to be short. Imagine saying, I want to be short, and then from this point to this point, you lost 7 trades. Well, that's insane. You know what I mean? It doesn't make a lot of sense. So you got a directional bias from a signal. Take it and hold it and wait. That's the idea. That's what we're getting at here, is that you can have what's called a tight stop, meaning ultimately I'm risking 1%, 2%, 3%, right? But ultimately, you're in a position to where I have a directional bias for the trade and the reason why. And then when that element changes, when my reasoning changes, right, the trigger, when my trigger changes, my trigger is short there. When my trigger changes, or I happen to have some massive candle that takes me out, so be it, then I have to get out of it. But until then, I'm patient. So here we are, we're talking about a 2-hour, and look at what it's given us. I mean, to this point in time, you're talking 8, 9, 10%. It's a hell of a trade, right? But I don't want to make it all seem like roses. It's not always going to work that way. In this situation, though, does it catch? Part of, I don't even want to claim that it catches anything like that. So even if it did, let's ignore that, because that's a big thing. But of course, it did give you a buy here. So if you were in a short from here, you see the damage isn't as bad as you would think. Not to mention your swing high was there anyway, and you would have got taken out there, so you'd be okay. So that's kind of some of the understanding ideas that at times is going to help you out in those situations. Now here's a good example, because you end up getting a short somewhere in this area, so wherever you end up taking it, you do see a couple things. One, it dumps out, so you probably had some element of a take profit, or 2 take profits. Again, in part 2, we'll talk about how you use your support and resistance as a take profit 1 and take profit 2, those type of things that you really should already kind of understand for the most part. But regardless of that, you can also just look that if you're following the process, even something like this doesn't get you out so bad. A lot of times they'll just get you out maybe even. So you're hoping, because I know that's part of the thing, is like, look, market gets choppy and I'm getting chopped up. Well, if you take it like this, you might have 1 loss, right, instead of 7. And 1's okay, right? Or you find the trend and you participate in it. And that's kind of the idea of this entire strategy. And if we go back, of course, I am cherry picking a little bit, right? Because there was some chop elements in here, but it's 1 loss, 1 trade loss, and that's it. Blue never crosses in this situation. Well, technically, I'm calling that a loss. Wait a second. Forgive me. Let me look closely here. Yeah, I will call that one a loss, because I will say that technically this one got me out of this previous trade and then re-entered in there, because I do see some blue that crossed here. For a second here, I was thinking, wait a second, never even crossed. But now let's look at this area right here. 2-hour. This is a 2-hour scale, guys. So my signal happens over here. Consolidation that we always talk about, right? You get a consolidation. You're waiting for what? It's some interaction. Take out a low. That probably happens about here as an example. I'm not going to get too close on these, but you can see that some of these low time frame trades, you're patient, you wait for a recross, it never happens, right? You had your swing high up here, ultimately an ATR or more, maybe 2 of them. And what you end up seeing is what? The payoff, right? This is 20-something percent. That's insane. That's a significant gain on a 2-hour chart. And you'll find them all over the place. I'm just giving you a couple examples. You'll find them all over the place. I'm not even talking about this. What if we start moving up again, right? Obviously a lot of you guys are Bitcoin fans for the most part, if not all of you. This is on a 2-hour chart, guys. It doesn't take much to kind of peek and just kind of see what we're talking about with these particular signals over and over and over again. And I know I'm taking it from bottom to high just to show the maximum percentage, of course. So Obviously, you wouldn't be gaining all of that, but you guys are savvy enough to understand that if I'm a part of that, if I gain half of that, then it's still 20 something percent. If I happen to be fortunate enough to gain 60, 70% of it, still a great gain, 40 something percent. And this is on a 2 hour now. Now we're on a 2 hour. Let's go further down. All right. Now we're getting to what? This is like degenerate mode, right? I used to trade these, so I'm not calling anyone degenerate, so don't worry. But what's interesting about the degenerate mode is that you'll notice that some of these sharp little trades, you'll catch them, right? Short right there, consolidation afterwards. So there's your short. Here's your consolidation. Then you get your down candle. You enter. You're waiting for a complete recross. Otherwise, you get payoff again. Again, if you get a giant candle like that, guys, take a little profit, right? Always. Why? Because you might decide to add back, and that's fine. So I don't have a problem if you said, hey, I took profit here, and then I added back some here, etc. Then that's just trading. But you'll want to try to start to get into the ebb and flow of understanding that, hey, if I'm on a 1 hour trade here, and 14 hours later I'm up 8%, 7%, okay, guys, that's a lot of money. A lot of people, professionals in stock markets, they aim to make that in a year. I know people don't understand that, but that's reality. And I'm glad I brought that up because I'm going to put you into some stock. So I won't give you too many examples here, but you can kind of just see if you familiarize yourself with the colors. Of course, I know you're going to be able to do this on your own. Are there some chop areas in here? Yes. In fact, let me try to find one. I'd rather show you one on this low time frame. So this is an hourly, right? I do like to do this on stocks on the hourly, right? I wouldn't say that I necessarily do it on Bitcoin. Not to say it won't work. It will. I'm just saying that I don't do it often on Bitcoin. It's just not something I utilize on that. But what are we looking at here? All right, so this is a buy as an example, right? And I'm thinking this one's not going to work, so I want to show that. So where do I set my stop? I set it down here, right? Because it's a swing low. Here's my entry, okay? And that's going to help me determine my position size, as you guys know from video 1 of this whole series. And what does that tell me? Consolidation is going to come. I wait for that area to get taken out, which is probably about here, it looks like. Doesn't matter. You're up a little bit, you're down a little bit, etc. But guess what happens? Recross. Oh, okay, that's one of the good things about these low time frames is that they recross without having a lot of damage. So this never really came into play. You lost 1%, 2%, meaning total on the position, not 1% of your actual risk management. So you started off with a very distant number that you never even reached. So you don't even, in this situation, as an example, maybe you really lost 0.1%. But then it gave you some element of a short. You have some element of a consolidation, some interaction, etc. Wherever you decided to get it, you'll see that it gives you some trend, right? And then the ones that don't, wait patiently, a payoff, right? And you shouldn't expect too much on these low time frames. So be careful. Once you get your payoff, take some, guys. That's the idea, or change your time frame. Same scenario now. Go down to like 30-minute, right? We're getting silly, obviously, with these scenarios, but look at, you just have to see that all the three under your white, right? So, as an example, that happened here. Some consolidation. Do they recross? Doesn't look like they do. And you have all of this, right? Now they recross here. Okay, I'm looking for longs. It doesn't look like it panned out ever, but if it did, it would have been a very tight loss. Again, you'd be looking for short. Now this is a good chop zone, right? There might be one or two chops on this time frame. Now I'm not telling you to trade all these time frames, guys. I'm not saying go to a 30-minute and take every long as short. No, of course not. That's why the higher time frames have a better element from there. But let's say you start to suspect, like, hey, I feel that a break is coming, right? You could be wise enough. Maybe you decided that over here. That, hey, you know what? This thing's been going on long enough. There should be a break coming. And you start to take these even on this low time frame. You could do that. Now, you would have been small loss, but now you would have been in here as an example. You've taken it 3 times. That you didn't come near your loss because you would have set your stop there and your stop there. But because of the recross of all of them, you got out much quicker. Hopefully you guys understand that and process that. If not, talk to each other and get it, because I'm sure some of you do. But the idea is that you ended up with a much smaller loss than your initial stop loss would have been at, right? Because your stop loss would have been swing or even swing down there. And in this case, you had a couple trades, right? Because you thought things were getting a little long in the tooth. Maybe the Bollinger Bands are squeezing or something like that. So you decide to enter on one of these crosses here. You wait for consolidation. Let's say your entry was a little bit lower. And finally, you catch a trend on this 30-minute. Remember, the trend is on the time frame. Right, so on that 30-minute, you catch a little trend. In this case, there's no recross again, and you max at a 6%. 6% off of a 30-minute chart is terrific. If you wait for the recross, so be it. That happened right up here somewhere, 4%, etc. Can you get caught on some of these? Absolutely, you can. So I'm not saying you can't do that. That can absolutely happen. That's normal, but if you're on low time frames and you get yourself a nice little move like that, guys, take profits again. That's just wise behavior. Again, we'll talk about these type of things of support and resistance and understanding that, hey, guess what? If I'm running into support, probably should take some profits anyway. So we'll talk more about that as time goes on the second video, because I'm going to cut this one off soon. But you can kind of see, by the way, should you trade a 5-minute? No, you shouldn't trade a 5-minute. You're crazy if you're doing that unless there's significant volatility. For that, you have something like the day trading strategy anyway. But would it work on a 5-minute? Look, if you're skilled and you want to trade on that time frame, I was just joking. You could feel free to do so. The idea is what? You'll see a lot of chop, but if you're on a 5-minute, of course, how long do you expect the trade to last? You'll see that, yes, you get into some areas. Now you want to see a consolidation reaction, and technically you're going to wait for a recross. It never really happens here. So this even on a 5-minute, it moves up from 74 to 75.15 and then back to break even. So you'll see some chop in these regions, but then you'll also see times where what? You end up getting this cross here. If you rode that in, yes, even a 5-minute can lead to some crazy breakout. Again, I'm not telling you to even think about doing a 5-minute, and if you want my honest opinion, you should not be trading on a 5-minute. But I'm just showing you that you'll see these trends come into play. Now, there's going to be plenty of chop on that, and there should be on a 5-minute, guys. That's kind of the idea of that in general. Again, if you really want to try to trade some aggression, then put yourself in a position to where you basically know exactly what you're doing. Now, I just want to give you a couple examples here to look at some other assets. Let's look at something. First of all, look at things like versus Bitcoin. And I'm going to get off. I want this video to slow down here. It's going to stop in a minute because I didn't mean for it to go this long. Okay, this is just first of all, you guys can do this. You don't need me to do it, right? Just look at some versus Bitcoin charts and things of that nature. But let's first start at something like scale. 12-hour as an example. These you're gonna see big moves, right, on these alts, especially like versus Bitcoin, because they like to trend one way or the other versus Bitcoin. Now, you'll see some areas of chop probably in there too, right? But remember, you're setting a distance stop to begin with. So these are positions that are going to last longer, and that's okay. If it lasts a few weeks and you lose your 1, 2, 3%, so be it. There's going to be plenty that last a few weeks or even go longer where you're going to notice that you either then got in on that, right? Or you entered on this on a short and it turned into that, right? So that's kind of the premise and the understanding. Now, keep in mind, you guys know all of this stuff already. I know some of you guys are saying, I already trade this way, which is fine. But for a lot of you, I'm hoping that this simplifies it. So give me some direct feedback, via DM, just to kind of tell me if this gives you any clarity. If you want to give feedback in the room as well, feel free as well. But the idea is that I think this should kind of clarify some things for you. Now, let's look at something like a stock. Now, a stock, I'll look at something like a daily, a weekly, and then I'll look at something like a 1 hour even for this type of strategy. For those of you that like stocks, me, I look for volatile stocks, right? So if you see the stocks that I trade, I look for volatile stocks, usually larger companies for the most part, not all of them, but usually larger companies that are slightly more volatile, just so that I don't have to think too much about what I'm trading. So when I get in here, I want trend. We always want trend. We want things that tend to trend, right? So let's look at this on a 1 hour. Nvidia, right there. Okay, I want some interaction consolidation. Comes back, it plays with them all, finally leaps out again. That's my reaction afterwards, right? Because I know that might get compression, I might get expansion. It's a little radical, but eventually, once I play with them moving averages, if I sneak back up to the long side, remember, directional bias tells me long. So if it's snuck down to the short side, I'm not taking that, right? So none of these are a play until it sneaks back off to the upside. So when that breaks up over here with a close above it, that's my entry. And then look, I would be long the entire time on a 1 hour trade, by the way, guys. This is on a 1 hour scale, which is very low for stocks, and there's no recross until right there. Let's call it the bottom of that candle. That's 12% on an hourly scale. It kept me in for 30 something days on a stock. I'm okay with that. You'll also find that there's some that are much longer. Sometimes I trade options with something as simple as this, and it works out very well because you'll catch a lot of these. Right now I'm looking at a 1 hour, by the way. Let's look at, now keep in mind, you can't go to like a 12 hour on on a stock. You can go to 4 hours, like a half day, but it's not normally something you would look at. I mean, I would trade like back in the day. I would trade even 1 minute, 5 minutes, those type of crazy things. But um, really nowadays it's 1 hour, 2 hour even, daily, weekly. That's what I'll look at for this. Go to a 1 day as an example now for the same chart, just so you have an understanding. Let me clear it real quick. You might look at, oh, I'm cherry picking. No, I'm not cherry picking. These are stocks that I look at in general. I'm just showing you that, the idea is we want to catch trends, right? And you'll see that there's these big trends. Now, there's a couple chop areas in here, and that's okay, right? The idea is I want to participate in big trends. That's how we make our money, guys, right? So here we go. You've seen me and heard me talk about the expression, look, the way we make the most money is by sitting, not by trading, right? I want to enter a trade that I sit in. And if you don't think that you can make off NVIDIA, even I take this on the high side, I don't think these recross, but let's just imagine they do. If they're 100% on NVIDIA, that's insane. Now let me switch it up a little bit. Let's just look at some of these other guys, right? Why show you that? I mean, I haven't looked at this, but of course I'm fairly familiar with most of these charts. But the idea is this. Look at the type of stuff you're getting with this, right? You're setting distance stops. 400% type of move becomes realistic on that scale. Now you might say, well, I'm not going to trade on that scale. That took a long time. But yeah, look at the results, right? The results are amazing in that situation. Trend on a 1 hour, right? Now I just showed you a massive long from the same stock, but look what trading the 1 hour gave me. That same cross. I understand there's going to be plenty of chop, guys, but there's no recross here, guys, and there's a maximum of 51% drawdown from a 1 hour type of trade. Again, significant, right? Amazon. Amazon likes to trend, right? Just go back in time as an example. And of course, I'm skipping many that are going to be losses as well. So don't get me wrong, guys. I'm going to acknowledge that you're going to see a lot of that as well. You will get chopped out with this strategy, and that's okay. It's just the idea is you'll get chopped out in a more distance, right, and a little bit further away. You're not going to be making 7 trades in a day that were all losses, or 5 out of 7 that were losses. And then ultimately, at the end of the day, your directional bias is right. That's the worst possible thing that can happen, so you don't want that to happen. You're taking a directional bias based on what? A trade idea like this, and you have a swing low, and if price doesn't get there, or if you don't get a recross, you're in it. So I'm in it from here until here, and then I'm out. By the way, it's still a significant gain there on that because this is Amazon. But regardless, you wait for the recross again. That happens here. You wait for some consolidation wherever you enter. Maybe you enter on the higher high, or after finally you get the swing high right there, and then eventually you're catching the big move, right? That's the idea. This is a 1 hour chart again, right? 1 hour chart. This isn't the daily. You want to see on the daily, forget it. The things you can catch. Now we're talking about real deal type of significant moves in those situations where now you're catching, God knows what you're catching in these type of situations, right? You're talking about, and then the recross, 96% again, right? So sitting on something that long is awesome. Go to a weekly. I'm not telling you to do these on a weekly, of course, right? But even something like a 3-day, I'm just giving you an example that you can fall into them right now. We're hindsight trading right now, right? So it's easy for me to say in hindsight, hey, pick Amazon. But the key is that the signal is there based on what we're talking about. I'm not saying, hey, I did this or should have this, because I didn't actually do this on a 3-day. So I don't want to, as much as I trade Amazon, I have not done this particular on a 3-day, which obviously I should have, right? But let's look. On a 3-day scale, this thing got you, first of all, what's better than holding something for 4 years? That is great, and you wouldn't consider doing it. But the fact is, unless you knew that it was going to do this, but with this, it keeps you in, and keeps you in, and keeps you in, and keeps you in, and you end up with 400 and something percent, which is just a thing of beauty, right? So that type of thing can happen, right? Because ultimately, the trend is your friend until the end, right? So, and this is the basis of this simple strategy. Okay, should I go into anything else? Should I look at anything else? You won't get these gigantic trends in forex. So certainly you wouldn't want to do a forex. If we look at something like pound yen, just an example. Can you do it at scale though? Yeah, at scale it's a little bit different scenario, right? So I don't, you can, don't get me wrong, you'll find some trends, right? It's just you want to be careful that you don't get chopped too much. So all markets, all time frames. Again, you can do this, but my point is at scale. That's when you're gonna get into something big on forex. Would I use this on forex? Yes, this is exactly what I used in forex when I started using it. Literally this strategy. Okay, so the idea is, but on a high scale. See, a lot of these guys they want to do these big leverage, and they're at a 100 leverage or things like that. I don't use 100 leverage on forex. It's not my thing. Why? Because I'd rather give myself patience and time to where I say, all right, I'm entering here or waiting for some, I'm waiting for an entry in this area, etc. Wherever it was that you enter, you're in a situation where you say, look, my stop's way up there, right? If I get stopped out and I lose 1%, 2%, so be it. But otherwise, in Forex, if you guys are familiar with, I don't know if you understand this or not, but this is not stocks. 11% in Forex is unbelievably huge, right? So you can catch, again, trends, and that's what we want. We want to catch trends. Are some of these going to be not as efficient as they appear, meaning they might look wonderful, but if you did wait for the full cross, and yes, you did lose some gains, obviously, in these areas, so we get that. But my point is that it will work in any asset, any market, because you are looking to find a trend. Now, I do want to show you that, look, on a lower time frame, Forex will love to do this kind of stuff, right? A lot of this ranging, and there's ranging strategies that you can utilize for something like that make more sense when getting things like Bollinger Bands. These are very simple strategies that are available on the internet anyway, but the idea is that it's not that it's not working, so you're not going to see that. It's just that do you want to be living on such a low time frame? Not really, right? You can get a directional bias and maybe formulate some other type of trade idea, etc. So that's just a off-topic type of tip, is that really on Forex, you're not ultimately looking, unless you recognize trend first, that's a different strategy. Or so when you say, all right, well, I got a breakout and say, okay, I think we're trending, then you can utilize some trend-based strategies for that to get involved in it. But if you're just waiting it out, saying, oh, wait, things have been sideways so long that I feel like the Bollinger Bands are squeezing, I'm going to have a trend. No, 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 not necessarily. In Forex, it doesn't really work that way. So just be careful with that. Okay, for you guys that already trade the Forex, obviously you're well aware of that already, but I just want to point that out so you guys don't decide you're going to just run with that. But let's look at something like gold. I said I was going to cut this off, but obviously when gold starts trending, look, this is a 1 hour, you get your cross there, you're in this thing the whole time. Again, now, yes, I'm picking best scenarios, of course, right? But you could see this. This is, again, a 1 hour chart, and you're getting over the course of 8, 9 days, yes, 3%. That's a good move. That's a very good thing. Now, do you trade gold on the 1 hour? Not that often, guys. So that's not something you would normally do, to be honest with you. But what do we see? All right, let's see. Cross right there. Consolidation. A little bit of a breakout finally from it. So wherever your entry is in this area, we know that we have a directional bias to be long. And the first time we ended with a cross, it still got us about 4%, but then we get it again, and you end up with the consolidation over here. If you take it in this spot right there, forgive me, right there, you end up now 16 type percent at a maximum. Obviously, it comes back down. Maybe you brought that down to 10, etc. You get the point. You can have the exposure to this type of stuff, like the downside. Huge move to the downside when it was in play at scale, when it showed us at scale that it could happen. So again, we'll look to start integrating other things and talk about it in more detail. But ultimately, what I would say is that, look, you want to put yourself in a position to start giving yourself a little bit room, not drive yourself so crazy on the lower time frames. If you are on the lower time frames, again, give them some room as well, right? Tight stop means what? Don't let it go to a previous swing low, etc. Or if you're really trying to get, like for instance, if we're in gold chart here, but if I entered here, is my tight stop going to be right in this spot? No, it doesn't have to be, as long as I set my risk properly and say, look, swing low is going to help me to make a decision on something like that if I have a proper directional bias. Now, if you don't have a proper directional bias, well, then you're crazy to set your stop over here. But if you're saying, like, no, I have a reason to have a directional bias that's to the upside, set your stop there, and then when you clear that path, move it up over into that area again. And then when you start to clear these areas, you establish another swing, etc. You swing low, then fine, move it up, move it up, move it up, and then ultimately you put yourself in a position where you don't have to worry about loss anyway, and then you wait for your cross, ultimately give you the signal even at a higher level or until it dumps out. But give me some feedback on this, guys. I want to know, does this help you? Does this shed some light on some things? I want to know. I think it will a lot ultimately. Normally, what happens when people see this, they go, oh my goodness, why didn't I have this before? Well, it's a simplified version, right? So we're talking about strategies, and if you see it that way, that's a good thing. That means that you do probably understand a lot more than you thought before. anyway, if that's the case, or maybe you're misinterpreting some of this, you just got to watch this video a few different times. But hopefully it helps. Again, we'll go further in detail about it, but just stick with this for now as you're doing some research and analysis and kind of back test it a lot. Forward test it if you'd like as well, just to see how it's working. Does that mean the very next one is going to work? No, not at all. It might be, you stop out. That's okay. But what you'll see is that it is a strategy that has an edge and therefore is going to make you money over time. I feel extremely confident telling you that. Okay? I'm out for now.